What's going on, everybody? Welcome to today's video. So today we're basically be going over just how to navigate through your trading session. So since we predominantly trade futures here, we're gonna be focusing on New York AM session, of course. So um, for those of you that trade London or plan on trading London, this can apply to you. You just switch it around from your primary session being London and previous session or pre-market being Asian session. Anyways, so basically we're going to be going over pretty much how to navigate through this session as like a live session. And also at the same time, we're going to be going over in case you guys miss a setup. What's going to happen if you guys miss a trading setup? What am I going to do? Am I gonna panic? Like, do I wait, or what am I supposed to do? Do I enter a trade early, or what am I supposed to do? So we're also gonna be going over that today. Now I know a lot of you guys, when you guys start demo trading as well as live trading, they're two separate things. Remember, demo trading is pure fake money. Don't worry about it. It's fake money. You aren't risking anything. You're just gaining a skill. Live trading or using a funded account to trade, that's going to put some anxiety on you because that involves psychology. That's going to involve emotion. And when you put emotion into the picture, that's going to make things a little bit more difficult because you're involving money. When you involve money, that's when things are going to get a little bit harder for you because you can't focus purely on the process of the candles. You're now focused on the process of the money. So when you're able to separate those two things, and by doing that, you need to develop yourself into a character by doing these things consistently on a daily basis, Monday through Friday. You will eventually develop yourself into trading the skill of demo and translating that over to trading the skill of live. Now, let's get started, okay? So during the pre-market, remember, market opens at 9:30. So if we take our vertical line and come to the 9:30 candle, which will be right here, this will be our New York open right here. So New York open would be this 9:30 candle. So 9:30 equity open, right? Pre-market, everything before 9:30 equity open is known as pre-market, right? Pre-market as in pre-market open, all right? We have our power of three here. Accumulation, right, during Asian session. We accumulate previous day during Asian session, as well as towards the end of previous day market close at 4 o'clock. We have accumulation. Once we get to New York session, right, between 3, which is when London session opens, Asian session and London session happens, right? Between 3 and 4, that is when the primary volatility will be jumping and starting up. Why? I don't know if you guys have learned this from another video or anything, but that is the primary time to be trading for a silver bullet setup. Now, I don't want you guys to pay attention to silver bullet right now, but 3 to 4 is usually when the volatility would jump, usually during London session. Now, it can happen pre-market as well during Asian session, but the most likelihood of volatility jumping pre-market during London will be between 3 and 4. So remember that, okay? Once we jump past 3 to 4, that's when the volatility starts, and that's when we start to have our manipulation move. When we manipulate, what do we manipulate to? We manipulate up into this 15-minute order block right here. Do we respect mean threshold of it? Yes, we do. What is mean threshold? Midpoint of the order block. Also, at the same time, what are we doing? We are sweeping buy-side liquidity here. So we have a turtle soup here, which is our manipulation move. So we manipulate higher. Usually when we have a manipulation move higher, taking out some level of buy side and tapping into a higher time frame PD, right, we are usually going to start to displace in the opposite direction. So once we come to the 5-minute time frame, we can start to see that we are starting to get some displacement to the downside here. Now, we do not have our official market structure shift until we displace over this low here. So this low will be our official market structure shift. Remember, we're not even awake during this time. We're not even trading during this. We're just going over what happened pre-market, right? Had our shift in market structure. Price jumps back up into this 5-minute fair value gap here. Taps into the fair value gap. Sweep of liquidity. Market structure shift. Fair value gap. Now we start to displace lower pre-market. We're not even trading during this time. So we missed this first setup. Market trades down lower. and keeps trading all the way until New York Open, which is at 9:30. Do we have any opportunities at 9:30? Yes, we do. When we displace past here, we had the possibility of coming back up into this breaker block, which was a 5-minute breaker block. So if we come to the 1-minute time frame, we had the possibility of, after we displaced with this candle, body closes over the candle, this previous bullish order block will be now known as a bearish breaker block. Because of that, we can now put a limit order. Market opens at this candle. We can put a limit order at the open of this breaker, which we would have got tapped into, as well as this 5-minute or this 1-minute fair value gap. And this is known as a unicorn setup, okay? A unicorn setup. And this is where you have a breaker block combined with a fair value gap. And this is a high probability setup for us. Now, this is not the model that I have taught you guys. I have taught you guys the 2022 model, like this one here. But I am just giving you an example of how to navigate through price and how to identify what price is doing. We tap into this unicorn setup here. Now we carry on with a continuation short now. After 9:30 happens, if you do not have a setup at 9:30, what I want you guys to be looking at is the 3 macro times. 9:50 macro, 10:50 macro, 11:50 macro. These 3 macro times are the macros that are going to be focused for us when we don't catch that setup. So next thing we want to be looking for after 9:30 is the 9:50 macro time. So at 9:50, price is going to want to do one of 3 things. It's going to want to either fill in an efficiency, rebalance price at equilibrium, or take out a level of liquidity, right? So if you come to the 5-minute time frame, we sweep a level of sell side here. So we swept a level of sell side pre-macro time. So what we could possibly do is sweep a lower time frame level of liquidity after we swept that higher time frame level of liquidity. So we do that just here. Also at the same time, we come down into tapping into this 1 hour fair value gap. After we tap into this 1 hour fair value gap, we see that this is a higher time frame mitigation. And this is also a type of inefficiency. So because of that, in between the 9:50 and 10:10 time, which is our 9:50 macro time, that is an opportunity for us to identify one of 3 things: price filling, balancing, or taking liquidity, which is going to be this fair value gap. So in this instance, we had filled a level of liquidity. So since we filled a level of liquidity, it's usually going to reject in the opposite direction after we fill this draw on liquidity. This was the draw during the macro time. So because we filled this, we're usually going to displace in the opposite direction to either do one of 3 things again: take, fill, or balance liquidity. So in this case, since price came all the way up to here, filled this fair value gap, came all the way back down to here, created all of these buy side liquidities that hasn't been swept yet, all of these buy side are engineering targets for us to take out. So we here have multiple targets that we could possibly take out. So after this, we can anticipate a setup for us forming here. So because we got that major fill, we got our sweep of liquidity, next thing we need is our shift in market structure. So what can we use for our shift in market structure? This is our intermediate term high, but this is our short term high right here. So once we displace over this high right here, this would be our lower time frame market structure shift. Once we displace over this high, that'll be our indefinite market structure shift, because this is our intermediate term high. So because we displace over this one, that's indefinite that we should be coming higher. But since this is our short term, lower time frame fair value gap with a market structure shift, so this is our market structure shift, fair value gap here. Now, why wouldn't we enter on this lower fair value gap? Because we didn't get that market structure shift down here. We got it right here. Also, remember advanced gap theory. We displaced while creating that second gap. So when we create a second gap plus displacement, that's a good indication to us that this fair value gap, this first fair value gap, will be known as a breakaway gap. And you can anticipate that over time. So this is our 1 minute fair value gap. Since we didn't get our setup pre 9:30 or at 9:30 or between 9:30 and the macro time, This can be our setup now. Do not enter at consequent encroachment of a gap. Always enter at the open. But Pono, it's going to ruin my risk to reward ratio. So what? Lower your size. Lower your size, guys. So, move your stops to the first candle's wick low. Right, a couple ticks right below it, I would say. And that's being generous, alright? That's giving you enough space for the market to do its thing. Once you can see price having a body close over this gap, that's when you can start to consider pulling this trade because it's disrespecting the gap now. But remember, the wick can go as far as to Neverland and still have a body close in this fair value gap and still respect the gap. That's why you want your stops to be at a decent area so that when you do get stopped, you aren't losing that much, but also it's allowing you as much space possible for the price to do its thing inside this fair value gap. You see how many times it touched it? Touched it 1 time, 2 times, 3 times, 4 times. It needs to do its thing inside this gap. If it doesn't allow price to do its thing, then you're going to get stopped out and you're going to miss out on this move right here. So, because of this, we want to be targeting at least a 1 to 2, which would be at right at this 5-minute breaker, which we already previously tapped into. But price has didn't indefinitely tap into it because we didn't come into it right after displacing lower. And we have huge displacement here. So because of this, this will usually be most likely be our trade in this case. But let's say we miss this trade, right? We missed this whole total setup right here. Next thing we're going to be wanting to look at is the next macro time. Okay? We're going to be looking at this next macro time. So, next macro time. We already filled liquidity. Already tapped into a breaker. What can we anticipate price doing now? We can anticipate price on displacing lower to either take out another level of liquidity or rebalance liquidity, right? So if this is our trading range from this low to this high, we can anticipate price will probably rebalance itself right at equilibrium of the range. So because of that, we can intend price to do something around this area. So what do? Come down, rebalance price at equilibrium, and we come up and we start dancing in this area before continuing down even lower now. Now how can we anticipate what to do while we're in this equilibrium? Well, we already displaced down bearishly, right? We also previously had taken out buy side liquidity here, as well as all of this buy side liquidity down here. All of this buy side that didn't get taken out, we took that out. So we have our liquidity sweep. If we're looking at this 2022 model, what's the next thing we want to look for? That market structure shift. Okay? Now where do we get that market structure shift? This is our short-term low right here. Do we displace through it? Yes, we do. Do we have a fair value gap right here? Yes, we do. But we want to be looking for that intermediate term low for that indefinite market structure shift, which would be right here. So we got our sweep of liquidity, our intermediate term low market structure shift. How do we know it's an intermediate term low? Short term low to the left, short term low to the right. And they're higher than the intermediate term low. So this would be our intermediate term low market structure shift. Displaced through this. Price comes, rebalances at equilibrium. Once price rebalances at equilibrium, price comes back up into this inverse fair value gap, which we can use as our entry point. Now, price displaced on this candle, and then it came up into it multiple times. Yes, you could have entered into it pre-balance, before it balanced it. But once it balanced it, you would want to be looking for this as an entry. So, tap into this fair value gap here. We can use this as an entry now. Price above this candle, because this is the first candle, but this is the higher part of the fair value gap candle. So stops right here, targeting sell side liquidity. Where's sell side? Low of the range. So because of that, we're going to be looking to target a 1 to 3 here and taking partials on the way down possibly. But in this instance, this is just an example of how we can anticipate where price is going to go. Tapped into a higher time frame PD ray, swept lower time frame liquidity, had an intermediate term low market structure shift, inverse fair value gap, rebalanced price during macro time. Now we can use this fair value gap as filling liquidity because we already balanced liquidity during the macro time. So we can now fill our fair value gap for our entry to come down lower. Now, obviously the rest of the day we chopped up a lot. And obviously at 11:50, this is our last macro time. So imagine we didn't catch this entry also. Didn't catch this entry, didn't catch that first entry that was right here, right? Didn't catch that first entry. Right about there. Okay? Imagine we didn't catch both of those entries, right? Imagine we didn't catch both of those. What we would do in this instance is we would look at the nearest draw on liquidity at 11:50. So remember, at 11:50, remember if we don't have a run on liquidity or run on price, right? We don't have a price distribution leg. We're going to be looking for the nearest draw on liquidity. And in this instance, the nearest draw would be sell side. So because of this, we will not have our best setup here. We are going to be having a bad risk to reward setup. Why? Because we are late to the trend and we are late to the distribution leg. Distribution started up here and we were late to it. So in that case, we're going to have to catch a slightly worse setup. So during the macro time, the objective was to take out sell side, which we did and definitely took out sell side. But what can we do to benefit off of an entry for us in this instance? Well, there is a particular thing that we can do. We're going to be looking at basic concepts, okay? Looking at liquidity sweeps, market structure shifts. We're going to be looking at advanced market structure, like short-term lows, short-term highs, intermediate-term lows, long-term highs, all of those. And we're also going to be looking at open price, okay? We're also going to be looking at open price. So let's start with open price. 9:30 happens, right? Let's go to the 9:30 candle all the way to right here. Price opens at 9:30 here. So we translate that all the way to over here. Price trades down, comes up. We manipulate above open price. Remember, when we manipulate over open price, that means we're usually going to start to displace lower because this is our manipulation move above open price. Now we displace lower. Obvious target is this sell side, but we didn't touch it yet. Once we come into our macro time, we obviously haven't came into contact in that yet until after the macro was over and we started to displace lower, right? So what do? We don't have a trade on. We didn't find our 2022 model setup. What are we supposed to do? We're going to be looking at basic market structure. This is an intermediate term high right here. Right here. That's an intermediate term high right there. We have an intermediate term high right here. How do you know? Short term high to the left, short term high to the right. They're both lower than this middle high. So that is our intermediate term high that we can use to our advantage to anticipate what market structure is going to do. Also, at the same time, since our market structure shift was all the way up here, every time we displace over a low now, that is known as a break of market structure, right? That is known as a break of market structure. So, next thing we can do is, since we don't have our market structure shift and we don't have our sweep of liquidity, next thing we're going to be wanting to look for is that we're going to be wanting to look for a break of market structure. Where do we get that? We get that here, right here. Right before we create our intermediate term high, we create our break of market structure right here. Okay. Now, with that break of market structure, we don't get ultimate displacement, but we do displace lower. This is where we really get our displacement here. So this will be our second break of market structure here. Now, there are two different setups we could have used. We could have used this fair value gap, but this wouldn't be a higher probability setup for us. What we would be using is after we displace over this black candle. What is this black candle, you may ask? This is a mitigation block. Why isn't this a breaker block? It is not a breaker block because we didn't take buy-side liquidity. Since we didn't take buy-side, this disrespected bullish order block would be now known as a bearish mitigation block. This would not be a breaker. Why? Because we didn't take buy-side. Once we take buy-side, that would be known as a breaker. But since we didn't take buy-side, this would be known as a mitigation. So because this is our mitigation block, once we displace through it, which would be this white candle, once we had that body close over that mitigation block, since price came back up right here, price came back up, opened right here, this would be our entry. And we would ride this right at the open. If we had our entry right at the open, we'd have our stops right above the mitigation block, riding it down all the way to sell side liquidity. And to be safe, I would put it over the next candle before it, or at least a decent amount away from the mitigation block, riding it down for pretty much a 1 to 2, pretty much rounding it up to a 1 to 2 at sell side liquidity. Now, this trade will not be as good as this trade. This trade will not be as good as this trade. But this gives you opportunities of chance during these macro times if you miss all of the previous available trades or setups to you, especially this one as well. If you miss this setup, you have this setup available to you. You miss this setup, you have this setup. You miss this setup, you have this setup. So it's just being able to adapt to what markets give you, just being able to adapt to the conditions that it gives you, and knowing when opportunities are available to you. And that's going to be during these 950, 1050, and 1150 macro times, and to anticipate what price could possibly give you as chance. Okay. Now, I know this is a little bit much for you guys, but it's just giving you a value of opportunity, and it's just giving you an insight of what I pay attention to when I miss my setups. When I miss my setups, this is what I'd be looking for. I'm looking at 1150 macro time, 1050 macro time, and 950 macro time. When I miss these opportunities for setups, I'm looking at my macro times. When I'm looking at the macro times, I'm looking at one of three things: filling an inefficiency, taking a level of buy side or sell side, or I'm rebalancing to equilibrium of a range. Alright? So, watch this video over again if you guys need to. If you don't, I hope you guys had taken down notes and paid attention to what I'm saying, as this is one of the most important concepts to know, which is value of opportunity and adapting to market conditions. Other than that, I hope you guys found this video very helpful for you guys, and I will talk to you guys later.